Good morning and welcome. I am Kenny Polcari, your host of the party, and today I'm coming to you from North Palm Beach, right here on the Intercoastal. You'll see some beautiful boats behind me as we're giving you this market update. You see the sky is kind of blue, a little bit cloudy, but you know what? It is an absolutely beautiful day on Tuesday, June 6, 2023. And here's what you need to know, right? So did the market finally make a top? Is it tired? Is it getting tired the way that I'd been discussing, right? Because yesterday, the markets declined. So you say, what happened? Apple introduces its latest game changer. But then you have to ask, is it a game changer right now? The Saudis moved in little to send oil prices higher yesterday. Well, they did send them high for about 10 hours, and then they backed right off. So now you have to ask, what's their next move? And is there a black swan event that we should be beginning to maybe just worry about? And what do we have for dinner tonight? We're going to have the Mussels Posillipo. Okay, so I will be in New York City tomorrow, and then the rest of the week I'll be on with Maria Bartiromo tomorrow at 7 o'clock, and then I'll be on Neil Cavuto's 4 o'clock program, and then Thursday and Friday with Charles Payne and Stuart Varney. Be sure to catch me there. Okay, so listen, what about this follow-on rally? What happened to all the excitement that stocks had on Friday? At the end of the day yesterday, we saw that the Dow actually gave up 200 points or 0.6%. The S&P lost 9. The NASDAQ lost 11 points. Not a big deal. The Russell lost 25 points, while the Transports gave up 160 points or just over 1%. Well, you can start with the banks, right? They came under pressure after it was revealed that the regulators are thinking about increasing capital requirements for the large banks, right? The XLF, which is the S&P Financials ETF, lost 0.5%, while the KBE, which is the S&P Bank ETF, fell by 2.2%. The big boys all lost ground as well, right? Goldman and Bank of America down about 0.6. JP Morgan lost 1%. Morgan Stanley lost 0.7%, while Citibank lost just about 0.2%. Tech, which has been leading the way up, came under some pressure, not a lot, but some, and that took the wind out of the sails. The XLK down 0.5%, while the SOX index, right, which is the semiconductors, was down 1.5%. And then Apple, they came out and introduced a new virtual reality product at the Worldwide Developers Conference, right? A mixed reality headset that retails for $3,500. Well, $3,499 to be exact, causing the once optimistic analysts to acknowledge that the price point would limit who could and would buy it, at least in the near term. We might see that price come down, over time, but right now it's a fairly expensive piece of merchandise. Now look, the buzz has been building all day long, actually for a couple of weeks now, months now, what Timmy was going to announce at this event. Everyone speculating on what it was going to be, and then he announced it, right? The AR/VR, augmented reality, virtual reality headset that will once again change the world, as well as, once again, isolating people more and more. And I mean, think about it. Think about what it does, right? The iPhone takes you out of the conversation because you're always looking at it. The iPod, again, takes you out of the conversation because you're always listening to something. The App Store, with all the apps, takes you out of the conversation. And this will eventually, too. It'll only take you further out of the normal conversation and put you into virtual reality, which will take you completely out of any human conversation. And why do we need this? I mean, what Timmy did not tell us was why I need to run right out and buy this. He did say that we'll no longer have to say things like talk to Siri and all that stuff, and what a relief that was. And for a moment, that news did send the stock to an all-time high, with Apple hitting $184.95 a share, which was a gain of better than 2%. That was until he announced that the new headset would not come to market until 2024, and then cost $3,500. By the end of the day, Apple fell by 0.75% or $1.37 to end the day at $179.85. Expect to hear more about this product today, tomorrow, the day after, the day after that, the day after that. I guess we have to wait to see what the developers develop for this product. And that will make it a must-have for everybody. Now, just FYI, Apple this morning was trading down in the pre-market about 0.4%. I'd have to look and see what it's doing now. But in any event, energy, which also had gotten a boost over the weekend after the Saudis voluntarily decided to cut their production by 1 million barrels a day beginning in July and extending it as far out to December 2024 if necessary. But that also failed to stay higher, right? Erasing most of those early morning gains that it enjoyed. Fan favorites like ExxonMobil and Chevron both ended the day lower after racing higher right out of the gate, right? The broader S&P Energy ETF, the XLE, also ended the day down by 0.6% as oil weakened throughout the day. Some suggesting that the Saudi announcement did little to stop the bleed. and that supply will outstrip demand as other suppliers bring oil to the market, forcing prices lower, and that any global slowdown will only exacerbate the demand-supply imbalance, right? Because as the global slowdown, then demand supposedly would retreat. Look, the Saudi budget break-even is $80 a barrel, right? That's what they need to support their lifestyle, which is why whenever the price of oil strays too far from 80, they go on their magic carpet and they fly into Vienna where they attempt to control the group, right, OPEC plus, and by default attempt to control oil prices. And that's what we saw happen once again on Sunday, where they tried to control it by, asking the group to cut production, which wasn't very successful. By all accounts, the market doesn't think they succeeded, at least not yesterday, because not one of the other members stepped forward to also offer to cut production, leaving the kingdom going it alone. While the media jumped on board warning of a global economic slowdown. One analyst in Germany now saying that oil prices are in a bear market, and we can see that some advanced economies are already starting to fall into recession, such as Germany. Now remember, we got that note last week that they are now in a technical recession. Traders are also awaiting Friday's CPI and PPI and trade data from China, which is the world's second largest consumer of oil, along with next week's Fed decision. All of these events and data points will serve as indicators of future energy demand, or at least that's the narrative. Oil ended the day at $71.91 after trading as high as $75.03 overnight Sunday into Monday. And this morning, WTI is trading lower again. It was down $1.63 or better than 2%, taking it right back to $70.50 a barrel, well below all three trend lines that are now about to converge at the $74 level, which suggests significant resistance. A few more days of oil teasing the $70 level is going to force the Saudis to reconsider what their next move is. And trust me, there will be a next move by the Saudis because, like I said, $80 is their sweet spot. And then we got a slew of U.S. economic data, and while both the PMIs remain in expansionary territory, anything better than 50 is expansionary, the ISM services fell to 50.2, when it was expected to be 52.4, so it's leaving it right on the edge of expansion versus contraction. The S&P Services PMI came in at 54.9, which is a bit stronger, but still below the estimate of 55.1, and that should have been, an all-clear sign that the Fed is succeeding, taming inflation, all right, weakening services sector, which is what they want to see, right? And that should give the Fed cover to skip a rate hike next week. But once again, the numbers make no sense, right? Last week, we created an enormous amount of jobs, mostly in the services sector, leaving many to ask, how can services BMI be weaker if the job growth in that sector was stronger, right? It's like a conundrum trying to figure out the conflict in the message. Okay, look, the rally that we've seen all over the past 3 weeks, really the last year, but say the past 3 weeks, has been about megatech, artificial intelligence, skipping, pausing, or even pivoting on rates, relief that the regional banks have not imploded, relief created after the clowns in D.C. that held the debt ceiling over our heads finally reached a deal. And while that's all true, let's not kid ourselves. It ain't all a bed of roses. There is still possibility that the Fed will resume hiking in July, which would be perceived as negative, and any cuts that the market expected in the fall, guess what? That's not happening. Commercial real estate, right? CRE loans. What happened to those concerns, right? They still exist, don't they? Consumer credit's at an all-time high, suggesting that consumers are living on borrowed credit and time. Wages are falling, not keeping up with inflation, which is still running at near 5%. And Mikey Wilson at Morgan Stanley tells us that profits are going to decline by 16%. And that then will force the S&P to test 3,000 before this is over, all while hedge funds have made a very large bet that the S&P will decline. Just because why? Because it can't go up anymore, which is actually a contra signal, which is exactly why it may continue to go up. That's another conversation. Yet the market continues to march upwards, right? It's illogical unless no one believes all of those negatives will come true, as the fear of missing out is stronger than the fear of being in, right? So it's FOMO versus phobia. The VIX, which is the fear index, keeps trading lower and lower. Yesterday, it ended the day at 1493. The last time it traded this low was in June of 2021, and before that was in the fall of 2019, suggesting real complacency. And that's a problem because everyone's just too relaxed. There is this sense that nothing can go wrong, that the sun is going to shine and the rain will never come. Let me remind you, that is not happening. At this point, all we need is just one unexpected event to ignite the fuse that will set it all in motion, right? Called a black swan that's lurking in the dark. Now, remember, a black swan is an unpredictable event that is beyond what is normally expected, having the potential to cause severe consequences. Now, doesn't sound very good, right? So, for instance, the pandemic and the global shutdown is just the latest such event, right? So while now you have to ask yourself, is there another one? Will it be a China invasion of Taiwan? Will it be China challenging the U.S. In the Straits of Taiwan? Will it be a Harris presidency if something happens to Joey? Will it be Vlad threatening even more destruction of Ukraine via nuclear warheads, bringing the world into World War III? This morning we learned that someone blew up a hydroelectric dam in the Russian-occupied area of Ukraine, causing all kinds of flooding on farmland across the country, never mind the potential damage to Europe's largest nuclear energy power plant. And that will surely impact the cost of wheat and corn, right? Because Ukraine is the breadbasket for Europe and much of the world. And we can already see, this morning we saw commodity markets react. Corn was up 1.5%. Wheat shot up by 3.5%. Now, I say someone because it's unclear whether it was Vlad or Volod who blew it up, right? As both sides are pointing the finger and blaming each other, right, for that catastrophe this morning. Now, this morning, U.S. futures were down. The Dow was down this morning 50 points prior to the opening. The S&P was down 5. The Nasdaq's down 8. The Russell's down 2. I understand now the market's kind of settled in, and actually all indices are slightly higher. Now, we can easily explain this as a move to digest a recent rally. You can also explain it away by calling out the weakness in Apple. Look, it's a $3 trillion company, so any move up or down will have an impact on all three indexes, right? The Dow, the S&P, and the Nasdaq, as it's a member of all those indexes. It's the tail that's wagging the dog, and you can also explain it away as the market is just overbought. Now trading at 19 times estimated earnings, right, which are 224. 19 times 224 gets us to 42.23, all while interest rates are approaching 5.5% on their way to potentially 6%, and that will cause a reevaluation for investors in terms of what we should be trading at. What multiple should we be trading at? Is it 19? Is it 18? Is it 17? European markets are all low. We're all lower this morning as well. The UK was down 2%. The CAC 40 down 2. The DAX down 0.1%. Eurostoxx was down 0.3. Spain was down 0.3. Italy down 0.4. Christine Lagarde hints at higher rates overnight, and the Reserve Bank of Australia surprised markets and did raise rates unexpectedly. German manufacturing fell by 0.4% versus the expected increase of 0.3. New industrial orders are down 9.9% versus last year, and a decline in energy prices is weighing on that sector as well. Gold bounced higher yesterday and was up again this morning, right? Trading at $19.78 an ounce, right? It is the idea that we discussed. If the Fed skips, then the dollar should back off a bit, and that will help support gold. It's also negative global geopolitical events will force a move into the safety of gold. So think about what happened over in Russia and Ukraine last night. Think about China and Taiwan. People will flock to gold just because it's gold, right? At the moment, the trend lines are really defining the trading channel, and that trading channel is 1975 on the downside, 2020 on the upside. The S&P closed last night at 42.73, down 8 points, right? So could this be the start of a pullback that I've been talking about, that I've been referring to? Well, we don't know yet, but it could be, right? Are you ready? Get that shopping list together. Add to the names you own that become arbitrarily dislocated, or stick to the plan of just keeping your dollar cost averaging, keep dollar cost averaging into your portfolio, right? Picking up the names that are more dislocated than others. If you're nervous about a decline, then position yourself with some of the contra trades that offer that exact protection. So the SH, the PSQ, the DOG, even the VIXY, VIXY. Now, just FYI, none of those are meant to be long-term positions. They are meant to offer short-term protection. So you don't buy it and forget it investments, right? So make sure you stay on top of whatever it is you buy or sell. I, for one, am adding new money to sectors that have become underweight in my portfolio. Think financials, energy, and healthcare. And if tech suddenly becomes attractive, then I'm going to add to that. But right now, that's not happening because tech is, in my mind, a little bit stretched, right? We remain in the 41.30, 42.90 trading range on the S&P. But remember, a move down to 38.50 would only represent a 9% pullback, which is well within what is considered a normal trading range and a normal trading pattern. So if the market should start to back off and look to go down that level, there's no reason to panic. It's all considered normal. Okay, so what do we have for dinner tonight? This is a dish I love to make, and because it's summertime is coming, it's a great summer dish. It's Mussels Posillipo, right? It's an easy recipe. You can use it for clams and mussels. You can make a combination. You can do just clams or just mussels, right? It's also great either just with some toasted Italian garlic bread, or you can put it over pasta like linguine. For this, you need the mussels, 2 dozen. You need thoroughly washed and cleaned of any sand. You need white wine, clam juice, garlic, onions, olive oil, salt, and pepper. You need 128-ounce cans of imported Italian plum tomatoes, not puree, and you need obviously fresh basil. Now, in a pot, you want to heat up the olive oil, saute the garlic, right, until it's lightly brown. Don't burn it, you know the deal. Add in the sliced onion and saute until translucent. It's probably, 8 minutes or so. Now you're going to add in 1.5 cups of dry white wine. You know me, Pinot Grigio, Santa Margherita, nothing fruity, not Chardonnay. The Pinot Grigio works well. Stir it, let it come to a boil, let the alcohol burn away. After about 2 minutes, you want to rough crush the tomatoes and add those to the pot. Now, when you rough crush them, you literally take them out and crush them with your hands, right? Because you want them to be kind of chunky. And you just want it to be chunky, right? Now, you can also use a blender, but do it quick. Don't puree it. You don't want it to be a sauce. You want it to be chunky. Add enough tomatoes to give it some substance and color. You don't need to add the whole can unless, of course, you're going to serve this over linguine, and then you would want more tomato. If not, then, half of the can is fine. Now, add the small bottle of clam juice that you bought and the fresh basil leaves. Rip them up and add them in there. Season it with salt and pepper. Turn the heat down to simmer and cook for about 15 minutes or so. Now add the mussels to the pot. Cover it tightly. Cook until the shells open. Maybe it's 8 to 10 minutes max. Shouldn't take any longer for those shells to get nice and warm and then open up. Discard any of the mussel shells that do not open. So if you find one or two that open, just toss them away. Present this in a dish in a large bowl, really a large white bowl for the summertime works great, and you want to bathe them in the Posillipo sauce. This dish demands, like I said, toasted Italian garlic bread that you can use just to dunk up the sauce you're going to have, whether you're drinking wine with it, whether you're out on your balcony in the summertime, or maybe you're even down on the beach. Maybe you want to drink it with a cold beer. Either way, you'll never go wrong. This is a great dish. It'll become a family summer favorite. In any event, it's another gorgeous day here in Florida. Tomorrow I'll be in New York City for the rest of the week. We'll talk to you from there. Take good care.